Pay yourself first. You get paid. You pay your bills, buy groceries, handle expenses, and whatever's left over, if anything, goes to savings. That's why you're broke. Rich people do it backwards. They pay themselves first. The moment their paycheck hits, 20 to 30% automatically goes to investments. What's left is what they live on. Savings isn't optional. It's the first bill that gets paid. You're hoping there's money left over at the end of the month. There never is. Expenses expand to fill available income. That's Parkinson's law. You make $5,000 a month. You spend $4,800 and save $200 when you remember. That's $2,400 per year, maybe. They make $5,000. They automatically invest $1,000 first. They live on $4,000. That's $12,000 per year. Over 20 years at 8% return, your inconsistent $2,400 per year becomes $118,000. Their consistent $12,000 per year becomes $589,000. Same income. 5 times the wealth. The only difference is the order of operations. You can't save what you can see. If it's in your checking account, you'll spend it. They remove it before they can spend it. You're relying on discipline. They're relying on automation. Discipline fails. Automation doesn't. Automate everything. You plan to invest $500 this month. You'll do it when you have time. Life gets busy. The month ends. You forgot. Rich people don't rely on memory or motivation. Every financial decision that requires willpower will eventually fail. You'll forget. You'll make excuses. You'll prioritize something else. They automate investments, bill payments, savings transfers, everything. The money moves without them thinking about it. You're making the same financial decisions every single month. Should I invest? Should I save? Should I pay extra on debt? Decision fatigue kills follow-through. They decided once, 5 years ago, to invest $1,000 per month. It's been running on autopilot ever since. You're deciding every month and failing most months. Automating removes the emotional component. Market crashes? Automation keeps investing. Feeling broke? Automation keeps saving. Want to spend? Automation moved the money before you could. Your willpower is a finite resource. You're draining it on repetitive financial decisions that should have been automated years ago. Here's the reality. The best financial decision you'll ever make is the one you only have to make once. Set it. Forget it. Get rich. Asymmetric returns. You're trying to save money by cutting lattes, skipping lunches, and canceling subscriptions. You're proud of saving $200 per month. Rich people aren't cutting expenses. They're increasing income. Expenses have a floor. You can only cut so much before you're living miserably. Income has no ceiling. You cut $200 per month in expenses. That's $2,400 per year. Congratulations. You've optimized your way to an extra $2,400. They spent that same time building a side income stream that generates $2,000 per month. That's $24,000 per year. You can cut expenses by maybe 20 to 30% if you're aggressive. They can increase income by 100%, 200%, 500% with the right strategy. But here's the problem with your approach. Cutting expenses makes you miserable. You're sacrificing quality of life for marginal savings. Increasing income expands possibilities. A $10,000 raise is worth more than years of coupon clipping. A side business generating $500 per month is worth more than a decade of skipping coffee. You're optimizing the wrong variable. Expenses are capped. Income isn't. When you increase income, you can save more and spend more. When you cut expenses, you just spend less while staying broke. Focus on earning more, not spending less. The math isn't even close. Buy assets, not liabilities. You get a bonus. You buy a new car, upgrade your phone, and treat yourself to a vacation. You feel rich for 2 weeks. Rich people buy assets that generate income. Every dollar you spend is a choice between an asset that pays you or a liability that costs you. That $30,000 car you bought? It loses $5,000 in value the first year. Insurance, gas, maintenance, another $4,000. You're down $9,000 in year one. They take that same $30,000 and buy dividend stocks yielding 4%. That's $1,200 per year in passive income, forever. Your car is costing you $9,000 per year. Their investment is paying them $1,200 per year. That's a $10,200 annual gap on the same $30,000. Over 10 years, your car is worth maybe $8,000 and cost you $60,000 in depreciation and expenses. Their investment is worth $44,000 and paid them $15,000 in dividends. You spent $30,000 and ended up with $8,000. They spent $30,000 and ended up with $59,000. Rich people ask, will this make me money or cost me money before every purchase? You ask, can I afford this right now? Different questions, different outcomes. Buy things that appreciate and generate income. Everything else is bleeding you dry. The 72-hour rule. You see something you want, you buy it immediately. You feel good for a day. Then you forget you own it. Rich people wait 72 hours before buying anything non-essential. The emotional spike that makes you want to buy something fades within 72 hours. If you still want it after 3 days, maybe it's worth buying. Usually, you forget about it. You're making financial decisions in a dopamine-fueled emotional state. Retailers know this. That's why they create urgency. Sale ends today. Limited stock. They're betting you won't wait, and you don't. You impulse buy $300 per month on things that seemed important in the moment. That's $3,600 per year wasted on things you barely use. They implement the 72-hour rule. Maybe 20% of those impulses survive the waiting period. They spend $720 per year instead of $3,600. That's $2,880 saved annually by just waiting. Most of what you buy you don't need. You buy it because you're bored, stressed, or seeking a dopamine hit. Retailers have weaponized your psychology. The 72-hour rule disarms the weapon. Wait 3 days. If you still want it, buy it. Most of the time, you won't even remember what it was. Tax optimization. You get your W-2. You pay your taxes. You think that's just how it works. Rich people pay a fraction of what you pay legally. The tax code is written to incentivize certain behaviors. Investing in real estate, starting businesses, funding retirement accounts. Rich people structure their lives around these incentives. You're paying 25 to 30% in taxes on your W-2 income. They're paying 15% or less through capital gains, tax-deferred accounts, and deductions. Same income level. Half the tax bill, you make $100,000, you pay $25,000 in taxes, they make $100,000, they pay $12,000. That's $13,000 more per year you're giving to the government because you don't understand the tax code. Over 30 years, that's $390,000 in extra taxes you paid that they didn't. Tax optimization isn't cheating. It's using the rules as they're written. Mortgage interest deduction, retirement account contributions, business expense deductions, depreciation, health savings accounts. These aren't loopholes. They're intentional policy designed to encourage specific economic behaviors. You're ignoring them. They're maximizing them. You think paying more taxes is virtuous. It's not. It's ignorant. The government gave you legal ways to reduce taxes. Use them. Compound interest early. You're 35. You finally start investing $500 a month. You'll do this until you're 65. You think you're being responsible. Someone started at 25 investing $300 per month. They'll be richer than you. Compound interest is exponential, not linear. Time is more valuable than amount. You invest $500 per month for 30 years. At 8% return, you'll have $745,000 at 65. They invest $300 per month for 40 years starting at 25. They'll have $1,035,000 at 65. You contributed $180,000. They contributed $144,000. They end up with $290,000 more than you despite contributing $36,000 less. That extra 10 years at the beginning is worth more than your higher contributions. The first dollar you invest has 40 years to compound. The last dollar you invest has 1 year. Front-loading beats back-loading every time. You can't get time back. Every year you delay costs you exponentially. A 25-year-old investing $200 per month will beat a 35-year-old investing $500 per month. The gap is that dramatic. You're waiting until you can afford to invest more. By the time you can afford it, you've lost the only thing that actually matters: time. Start now with whatever you have. Time is the multiplier. Amount is just the input. Negotiate everything. You accept the first salary offer. You pay the bill as stated. You buy things at sticker price. Rich people negotiate everything. Almost everything is negotiable. Salary, rent, medical bills, cable bills, car prices, freelance rates, credit card interest rates. But you don't ask. You assume the number you see is final. They ask. And they get 10 to 30% reductions just by asking. You accept a $70,000 salary offer. They negotiate and get $77,000. That's $7,000 more per year for one uncomfortable conversation. Over a 10-year career, assuming 3% annual raises, that initial $7,000 gap becomes $86,000 in cumulative earnings difference. You left $86,000 on the table because you didn't negotiate once. Higher starting salary means higher raises. Higher raises mean higher lifetime earnings. That one negotiation affects every paycheck for the rest of your career. The worst they can say is no. And if they say no, you're exactly where you started, with the original offer. But they usually say yes, or they meet you halfway. Either way, you're better off than accepting without asking. You're leaving tens of thousands of dollars on the table over your lifetime because you're uncomfortable asking for more. They're collecting that money because they're comfortable being uncomfortable. Track net worth. You're proud of your $80,000 salary. You feel successful. Meanwhile, your net worth is $5,000. Rich people don't care about income. They care about net worth. Income is what you earn. Net worth is what you keep. You can have high income and negative net worth. You can have low income and high net worth. You're focused on the wrong metric. Someone making $50,000 with $200,000 in assets and no debt has a higher net worth than someone making $150,000 with $50,000 in assets and $180,000 in debt. High income doesn't mean wealthy. It means high cash flow. If that cash flow is immediately spent, you're just a high-income broke person. Net worth is the only number that matters. It's assets minus liabilities. Everything else is noise. You're chasing raises and promotions to increase income. They're optimizing to increase net worth. Once your net worth is high enough, the assets generate income passively. You stop needing a salary. You're trading time for money indefinitely. They're building assets that make money without their time. Track your net worth monthly. Watch it grow. That's the only scoreboard that matters. Side income streams. You have one source of income, your job. If you lose it, your income drops to zero. Rich people have multiple income streams. Relying on a single income source is the riskiest financial position you can be in. Your employer controls your entire financial life. They have salary income, rental income, dividend income, business income, freelance income. If one stream dries up, 4 others are still flowing. You're one layoff away from financial catastrophe. They could lose their job tomorrow and barely notice. You make $6,000 per month from your job. That's it. They make $4,000 from their job, $1,500 from rental properties, $800 from dividends, $700 from a side business. Total income, $7,000 per month, same as you, but structured completely differently. If they lose their job, they drop to $3,000 per month. Painful, but survivable. If you lose your job, you drop to $0. Catastrophic. Every additional income stream reduces risk and increases optionality. You can take career risks they can't because you need the job. They can walk away from bad situations because they don't. Rental income funds, more real estate. Dividend income gets reinvested. Side business income scales. Building additional income streams takes time and effort, but so does recovering from a layoff with no backup plan. You're optimizing for short-term ease. They're optimizing for long-term security. Start a side income stream today. It doesn't need to replace your job, it just needs to exist. Because the day you need it, you'll wish you started years ago.